Alrighty, let's go ahead and get started. Welcome everyone to the HUBB Live Trading Room. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing should be taken as personal investment advice. It's always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. The tariffs have found their way back to the headlines with claims and reports of the bad jobs report is caused by the shutdown and deportations and not tariffs, from one source at least. And so interested to see how that has its effects on the markets, among other things. And of course, very excited to interact with you all. So let's go ahead and kick off. Rob, how are you doing today?
Good, Zach. How are you? Hey, everyone. Welcome to the HUBB Live Trading Room. Hope you're having a good midweek hump day, as they say, on Wednesday. And we are starting to move into getting a little bit more information on where things may go with the market moving forward. When we take a look at the chart of the S&P, you can see I've got all these lines here. I'm going to probably take some of those off here at some point, like specifically we can take this one off. But we are consolidating nicely, actually. The move that we had up last week during holiday shortened week, low volume, that old expression that I keep talking about, never short a dull market, basically is referring to volume. When you have a low volume activity, markets tend to rise or drift higher. So that move up that occurred last week was expected. And then we did a quick, in the speculative portfolio, SPY put trade. Because what normally happens is that when you have that low volume rise and a lot of traders are gone and they've turned the Thanksgiving holiday in the US here into a 5-day holiday weekend, which they didn't used to do, but they have now, where they take off Wednesday through the weekend. So you get lower volumes. And that was clearly evident when you put on the volume underlay here. You could see how we rose up and volume drifted down throughout the week. So divergence there. Oftentimes you'll get a retracement. Sometimes you get all of the move retraced, which would have brought us potentially back down here towards the 670 level, or at least back to the 10-day moving average. And we did get selling on Monday with a down day, but not what normally occurs. And I think there's a couple reasons for that, which I'll go through in a moment. But as a quick in and out trade, 5% gain, but it was 5% in a day. So if we could do that every day, I think we would take it. Overall, it doesn't look like much, but there wasn't much of a follow through on the downside open that occurred on Monday. And then Tuesday, yesterday, we're back up, and today a little bit more quiet, a little less volatility in the market today. We'll see where the volume ends today. But one of the comments that I made during Trade Finder yesterday is if we were going to attempt a rally to the end of the year, we wanted to see the volume close on Tuesday higher than the volume that we had on Monday, meaning that there was no follow through to the downside move. And boy, we did, but just barely. So still viewed as being constructive, and we'll see where things in the day to day as well. But that's pretty darn good consolidation from that low volume move that occurred during the Thanksgiving holiday week. So that's constructive so far. If you're looking for negatives, we do have still a trend line here of lower highs. So to really feel better about things, we need to first step take out this high, and then we can start looking at taking out the previous wave 3 high. And another thing that you have to keep in the back of your mind is that the algorithm still has this wave 4 labeled as being active, meaning that all of this could just roll over and fall apart. I think it would take a bit of a black swan event for that to occur. If we take a look at the VIX, then we'll go to the bond market. You can see volatilities are staying down, trending back down towards that 15 level that's been support throughout the entire year, as you know by now. And we'll see if December end of the year rally can bring us down towards the 12 and a half level from last year, or maybe we just continue to maintain this slightly elevated volatility look into the end of the year. But if we go to the bond market, that's where it's been pretty interesting to me. You can see a little better move today, but was just a reflex at this point, a bounce back up in prices on the 20-year, therefore down in yields. But we had these drops where prices went down. There's been some stuff going on with Japan, dollar yield stuff, interest rates over there, talking about increasing them. So it's kind of been a global effect, not just on the Fed, but somebody actually was talking on the financial networks yesterday along the lines of what I've been wondering is if the Federal Reserve is trying to manufacture a steepened yield curve. We've been talking for, gosh, it feels like close to 2 years now. I don't know if it's been quite that long on how flat the yield curve has been, where rates have been pretty steady across the board. And that's not the sign of a healthy economy. You should earn more interest for holding a bond or security longer than the interest you can get if you hold it for 2 years. So it's been where you could get the same interest on 2 years that you could on 30. So why not buy the shorter maturity and keep rolling it over, compound your interest that way? But we'll see how things continue to move out. We do have a qualified zigzag on the TLT, which means prices could come back all the way down here, which means yields would move up significantly on the longer end. Maybe the Fed is really focusing, and oftentimes they do, to be fair, when they inject liquidity. And that's what we have had a tick up in liquidity from the Fed. And we'll see if they follow through and continue. They said they would start it at the beginning of December. So far, they have a little bit, not anything significant. And then we have the Fed meeting next week, and we'll see if we get that December rate cut. But if unless they're just going to go really hard on the short end, I'm not sure what brings the long end down this far, unless my point I was getting to is if they're trying to steepen the yield curve, calm down the housing market a bit, which has slowed down dramatically, but prices are still relatively high. And if they bring down or bring up rates on the long end, maybe that helps to quiet down the housing market and bring prices down a bit because that's inflationary, higher housing prices. So for now, we're bouncing up today. Rates are down, but again, we were a bit below the 10-day moving average. So as I started off, this could just be a reflex bounce, and then we turn and head back down. So I do want to keep an eye on the bond market. That's going to play into what's going on in the longer term movements of the market, and rates are coming actually down a bit today on the TNX. You can see how they jumped up along with the move in the 20-year, but not quite as significantly. So a slight steepening of the yield curve where rates went up on the shorter end, but not as far. And then when you get down to the 2-year maturities or less, they are actually rates didn't pop up like that. So again, indicating a slightly steeper yield curve. If we move into an environment where the Fed does continue to inject liquidity and we do get the December rate cut, then it seems like that could help keep a bid underneath the equities market. We'll just have to keep an eye on what's going on with the bond market. For right now, nothing too significant, but we head lower on that TLT zigzag. And if we were to break above this trend line, because remember, TNX actually does show rates, where TLT shows prices. They move inversely. We wake up in rates, then we're starting to worry about inflation again, and that could be a concern. So always something to watch, always something to keep an eye on with the way things are going. The one thing that is staying pretty steadfast, pardon me, at least at this moment, is the dollar still staying in the Goldilocks triangle, not going too low, not going too high. Perfect, right in the middle, Goldilocks scenario. We do have these two zigzags where their C wave extensions have not been reached yet, even though we've moved back down into the middle of this Goldilocks channel. If we do start to see rates continue their rise, that could certainly put a bid under the dollar and create a move higher to reach those two zigzags. And then, as I've been talking about over the last couple of weeks, if we did break out and hit those zigzag targets, we're pretty close to that previous wave four. And remembering Elliott Wave rules, when a wave five ends, if it hasn't extended more than 100%, you go back to the previous four. So for now, though, dollar constructive to equities moving higher. It's not hurting with the exchange rate, not helping quite as much as it was, but helping more than it's hurting at this moment, I guess would be the best way to phrase that. Then if we start to look at the other markets with the DIA, I've talked about this quite a bit. We drew the retracement here on the Fib retracement since the Dow had gone beyond 100%. Again, remembering Elliott Wave rules, if the wave five doesn't go beyond 100%, you go back to the previous four. If the wave five goes beyond 100%, you retrace to a Fib level. You don't necessarily go all the way back to the previous four. We did come down exactly to the 38.2% Fib retracement level. So that could be the floor for the DIA. It did a better job of holding this initial support level than the SPY did. And then we have 470 here, which would be even more bullish if we could hold 470 and then start to look at maybe taking out the high here around 480 and then the previous new market high that we made back in towards the middle of November. So looks pretty good on the Dow. We've got a lot of these right now, a bullish 1030 cross with a 10-day moving average moving up above the 30-day, 30 period moving average. So that's obviously a bullish sign. Going to the Qs, when we take a look at the Qs, then you can see that we are breaking higher here. There's another one of those 1030 crosses held right here at 610 on the pullback at the beginning of this week. But we did go down and test that previous B low on the zigzag. Can kind of take this zigzag off because it did everything it's supposed to do. I mean, it is 100% fully complete. We had a wave, B correction, up to the C wave, right to 100%, which was a second extension, our first extension, but it was an extension of the C wave. 61.8 was the target, 100% was the extension level. We got there, and then when a zigzag ends, you retrace the C wave. We did that. So we came back down to where the B was. All that's done. So that whole zigzag stuff is done. And now we're looking to see if we're getting a new impulsive move here, which would be a wave five. But once again, the algorithm's still keeping it green. So it's not all clear for a rally into the end of the year. So the old expressions of load the boat, back up the truck, none of those things are where we are. We just would view it. I would view it. I used to say, cautionary bullish, but let's go with constructively bullish at this point in time, just to change up the moniker a bit. And then the IWM, which is bouncing back today. And I drew the Fib retracement here as well, because I thought this was quite interesting. Another wave five that went beyond 100%. So we have two markets that are in a wave three and two that had wave fives that went beyond 100%. So, really strong moves in both of those, even though they didn't have the exact same LA wave counts. But 50% correction here on the IWM, right to the 50% level, and we move back up. And this 245 level is the key here. And we're doing a nice consolidation here from last week's move up, which was interesting. that the IWM moved up while rates were going up. We've talked about this a lot in the insiders meeting, and I've been borrowing the Fed's moniker of a dual mandate. You know, they're supposed to watch um, employment as well as inflation. That's their two main um, mandates. And with the Russell, you get two indicators, if you will, not necessarily mandates, but the IWM tends to move with rates. Rates go down, IWM usually goes up. Rates go up, usually the IWM comes down. But with this last tick up in rates at the beginning of this week, we didn't get a sell off here. We held this 245 level, which I think is quite interesting. And the second mandate or indicator, if you will, of the Russell is risk tolerance. A lot of people view it as high beta. Companies that are in the Russell that don't make money yet, they're new, they're smaller, and so the risk is viewed as being higher on companies like that. Obviously, buying a company that's not profitable has some inherent risk to it. So if the Russell is moving up, it's an indication that there is more of a risk appetite for the markets, if you will. And I think you have to conclude that with the fact that we didn't give some of that move back or more of that move back from last week, even as rates went up. So people looking at the Russell, it's easy one here. We do have a bullish 1030 cross, but it's got to hold 245. That's going to be key. If not, then we could fall right back down to that 230 level, and that could happen rather quickly. So still precarious in spots, but again, constructively bullish at this moment in time. All right, I won't go through anything else. We'll do that tomorrow night. Let's get to the AI signals, which is what we're here for, and look at the leader today. Check that out. And I know I cheated last week or the week before where I did kind of take a peek. I tell you that normally I don't look at the results because I want to look at them with you and walk through the thought process with you just as I was seeing them for the first time. I feel like that's more educational to do that. And I didn't look at them today either. So this is the first time I'm seeing them. And then good old Walmart right off the top. Look at that move. And I've been mentioning this week that retail has been a mixed bag. There have been spots that have done really well on retail, and even some of away from the discounters like Gap, Lulu, etc., are companies that have done well so far in this retail sales environment. We've been reporting that um, the number of late auto payments, late credit card payments is elevated. So part of the U.S. economy is struggling. But I've mentioned never underestimate the U.S. consumer. We find a way to spend somehow. And it's pretty evident here in the chart of Walmart. Now, you know how this works. You've seen these AI signals enough that they do a good job of catching momentum runs. And the only Elliott Wave component of the 300 plus data points that the data scientists use is the first day of a wave three. That's it. They don't analyze the algorithm. That's the part that we do after we get the signals. It's just it has to have been the first day of the new wave three. So we are in a wave three to the upside here, but look how vertical we are. And this is where that momentum part comes in. If you've been with us a while, you know how this works. Sometimes we see these signals. We've got a high signal here at 98% for Walmart to move up to 117 and a half, which would be a good move in Walmart. But look how vertical we've gone. And there's the 10-day moving average. So we're getting too vertical, too fast, too much separation from the 10-day moving average. The rules I talk about week in and week out in ad nauseum. And I do that one, because we get new people all the time, but two, because they're important and I want to ingrain them in your brain so it becomes part of your own trading toolbox, if you will, which whatever methods you utilize to make your trading decisions. So right now we do have support all the way down here at 110 for Walmart. which could happen. And furthering my point on the AI catching these momentum runs, when you see this where you're already overbought, we do know that sometimes we continue that overbought condition just long enough to reach the target, and then we pull back down towards the 10-day moving average. Other times the pullback becomes immediate. This looks pretty extended here. So, it looks awfully good. And we don't even really need to look. I can pull them up, but we know that Walmart is heavily traded. So there's going to be good liquidity in the options, but we'll just go ahead and pull it up anyway and take a look at it. And you can see there, even the December, it's got weeklies. As soon as you see weeklies, you know that you have good liquidity. So if we go all the way down, even January's monthly is only 44 days. So we're just starting where that time decay begins to drift down. It's more severe in the last 30 days, but it kind of starts at 44 days out. So you'd want to look, as we have been on the recent alerts, looking for February options. And again, thousands of contracts. This has been frustrating to me over the last couple of weeks. And the market makers can get away with it because the VIX is slightly elevated. These spreads are wider than they should be. Um, the VIX isn't that high and it's come back down, but they're allowed to widen the spreads in an area where they can say that, they have risk with higher volatility and the market's moving faster. So, hedging off the positions, unwinding their hedges, et cetera. They need time to do that. And so they're allowed to widen these spreads. But with this many contracts on a stock like Walmart, the spreads, they're still okay. I'm not trying to say that they're not. They're still around our 10% rule, but I just feel like they ought to be a little bit tighter than where they are. Not a whole lot, but a little bit. There's just a little extra spread that's in the options right now. And it's aggravating. Nothing we can do about it. We have to live with it. So this is an even more uh, not example, but uh, a further to the point of we should stay with options that are more liquid. So when we get in and get out, I've talked about this before. Just because there's not good open interest doesn't mean you can't get in and out of a position. But the market makers tend to be slightly more generous on the spread of allowing you in than they are when they allow you out. Because once they get you in, you're probably going to have to sell at the bid. You might be able to split the spread a bit getting in, but getting out on a wide spread with low open interest, you're probably going to be at or near the bid to get back out, and they can make a few extra bucks that way. So that part's frustrating, but still plenty of opportunities here. It goes back to what do we see here with this vertical move? Is this indeed something we would want to do today? And we're trading near the high of the day. I'm going to watch this really closely. You can see where we opened, and I was hoping that we would just kind of hover around there, maybe do a little sideways stuff, but hasn't happened. So that would have been nice, but moving to the upside here because even before I saw the AI signal. I've been watching Walmart because I've been feeling like, discounters with the fact that part of the U.S. consumer is struggling. It doesn't mean they're not going to spend, but they're probably going to spend. Walmart, Target, places like that seem to be doing pretty well, even though there's some select premium retailers that are doing well also. So, do we wait for a pullback to 110? Do we get in? If we wait, we may miss that run up. And if we get in, it may pull back. So, what do you do in this scenario? And one of the things that I've been talking about in order to hedge off this risk that comes in with the fact that the AI catches these momentum runs so well is if you want to get in, even though you have to be aware it's overbought short term. We've broken out vertically here, broke above 110, which was resistance from October. So we've broken vertically. The 10-day moving average is still below 110. If you want to get in, though, so that we don't miss a continued overbought run. It won't last long, but sometimes they last long enough to hit the AI target. Put on maybe half of a position. Whatever, we send out $500 or less of risk per alert that we send out. You have your own account. You know what your account size is. You're managing your own risk on that side of things. But if you want to participate and not miss out at all, because if you wait, I found that out in the early days of the AI signals. We're continuing to learn from the AI just as the AI continues to learn. And I just want to emphasize that it's true AI. It analyzes every alert that's sent out. How are the targets hit? What was the score? What was the analysis? And it's constantly improving. It's constantly tweaking those data points and getting better and better. And so I'm really excited for 2026. I think it's going to be a great year on the AI side of things. I really do, as it's getting more seasoned and seems to be getting a bit better and better on the targets getting hit. That doesn't mean that it's getting better on the ones that run straight up. I'm not saying that because we're always going to have that possibility when we're already overbought that the backing and filling starts first. And I know that gets frustrating and sometimes it takes time and you can see it on the alert performance. Sometimes we're in 1 to 3 days and that's it. We're out because it continued that momentum run. And other times it's a month because we do the backing and filling first before it goes up and hits the target. So it takes longer. So we know that it can go either way. But if you try to pick one, like if you try to say, okay, this is overbought, I'm going to wait, then you're going to miss some that continue up. That's the part I learned when I first started looking at the AI signals. You know how committed I am to being cautious when something goes too vertical or separates too much from the 10-day moving average. But there were opportunities that I missed because it continued that overbought condition just long enough to reach the target. And so you miss that alert altogether. You miss that trade. But then if you wait, or if you don't wait, if you get in, then you go through the pullback and they take some of that volatility back out. You deal with time decay. Sometimes we have to roll them. Those things all come into play as well. So what's the solution? Where's the midpoint? Where's the Goldilocks area, if you will, for analyzing these? And I think putting on half of a position when you see something like this, like if you wanted to get into Walmart, put on half of what you would risk than you normally would be comfortable with on any one trade within any one position within your account. If it runs up, at least you were in it. You might not have made as much money as you would have had you had a full position on, but you got something, and something's better than nothing. And if it does pull back, then you can add the second part, do a little dollar cost averaging, and that way you are getting your full amount of risk into a position. The first part would still be at a loss, but you lessen the net cost a bit with the adding of the second position. And then when it turns and runs, then you make back up what you were down on the first half and then some as you move past the point where you got in. So still a nice way to participate in all the alerts instead of picking and choosing. If you pick and choose, Murphy's Law comes into play, and it's always going to work out that, oh, if I wait on this one, it's going to be one that runs straight up. And if I get in it, it's going to be one that goes through a pullback. So try not to pick and choose. Make a uniform decision, if you will. And it's okay if you say, I'm just not comfortable getting in that. It's too vertical. And if I miss it, I miss it. But you have to be willing to accept that and not be upset that, okay, it was overbought when I got in or when I looked at it and it ran straight up and got even further overbought. I missed it. So don't get angry and upset about it. Know that that's the MO modus operandi that you've decided to feel comfortable with. The one thing I would discourage again is picking and choosing which ones you get in and which ones you don't. Um, because it just invariably will be the ones you get in pull back and the ones that you don't get in run straight up. Just psychology, part of it, if you will. We can take a look at our indicators. The CCI is elevated, but leveling off, and it hasn't taken out. This would be more concerning to me if the CCI here had taken out that October peak. So if we had a new extreme point high, I'd be a lot more concerned about it. And that would come into play with that hold. Do we stay away from it? Do we get in? Type of thing. It's kind of just hanging around in there. And I would imagine looking at the DMI, and again, I have not looked at this before. Yeah, the DMI looks pretty solid there. It looks like Walmart may go past that AI target based on the DMI. Things could change tomorrow, obviously. All we can do is analyze the data we have at any given moment. And markets change, data changes. And that's where just getting on my soapbox a bit drives me crazy when people complain about the fact that Elliott Wave relabels. That drives me nuts because that's one of the best things about it, in my opinion. I just mentioned markets are dynamic, they're ever changing. And a lot of indicators are lagging indicators, and it takes a little bit of time for them to catch up when the market goes through some sort of a changing phase where Elliott Wave relabels. And when it relabels, after relabeling, the math shows that after a relabeling, what occurs after that has a higher percentage chance of occurring than the original labeling. So it's a good thing. There's no case where it's a bad thing. The market changed. Maybe you have a position that's in the red. All right, what do we do about it? Do we just whine and cry and get upset about it? Or do we, buck up and fix it? And that's why I like to do adjustments. And sometimes the adjustment process takes time, but normally we get it right in the end. Not always, nothing's 100%. But being willing to accept positions that are negative or underwater is really important in the world of trading. Otherwise, you're probably not gonna you're gonna have an ulcer and quit trading. So we'll keep an eye on that. That's enough talk about that and general things. Let's start looking at some other symbols here. IYT is the transportation ETF. Goodness, look at that. Well, boy, talk about timing. Just giving me a perfect example of what I just went through on sometimes they just keep running and get up to the target while they're overbought before we get a chance to get in. This one, you can kind of understand what happened here because we did come running from a lower area around mid to late November, which created the vertical nature of that move. But it's this resistance area that it just broke today that's caused this big spike. There were probably some people there's always shorts, right? Zack talks about this in Trade Finder every week. You've got to have shorts. You have to have sellers, or there's no market. You can't just have all buyers. There has to be a buyer and seller for every single trade. And so when you have a resistance line like that, I may be a low percentage of short interest here on the transportation ETF. I don't know. I haven't looked at that. But whatever it is, they're going to have to cover when that resistance line gets broken. And that helps to ignite a move higher. And when you see that big of a move, it's an indication there was some short covering, but a lot of buying as well. So I would say that by the end of the day today, when we take a look at the volume here, that's going to be a pretty decent sized bar, probably back up here like we did towards the end of November before we broke for the holiday. So that one's too far gone. Not enough left. High was 75.32. I don't know where it is right now, but 75.67 was the target. So it's already there. So nothing we can do about that one. But wow, talk about perfect timing for the whole soapbox that I was going through on catching these momentum runs, and that sometimes they run all the way to their target in an overbought condition. There you go. There's an example of it. Wouldn't it have been nice to have it just consolidate right here a little bit before it decided to explode above resistance? I talk about that a lot. That's the ideal scenario. Well, it didn't give us that. I guess you could say it did consolidate for 3 days before it broke. I guess I'm just, you know, from a frustrated standpoint of, well, it would have been nice if it had given us another day or two so we could have participated in that move. Or maybe some of you got into it this morning because you saw the signals and you weren't waiting for the 1 p.m. webinar. If you got in at the open, you're pretty happy at this point in time. And normally I would have, but I am trying to stay true to my word that on Wednesdays when we're doing this, I'll look through the list with you rather than going through and putting them on in the morning and then saying, "Oh, look, that's." I, I always want to emphasize the fact that the main reason that we're here is to educate the average person. The traditional investment world is stacked against you. It's getting more and more stacked against you. I had a long conversation with an old friend last night that's also been in the markets for a long period of time, talking about how the world of education is going away as all these brokers, um, you know, 15 years ago, there were a lot of option education firms, a lot of them. There was a lot of option education out there, and the brokers have come through and bought them all up, and then they shut them down. They don't create, and this is an important note, and I'll get off this soapbox, I promise. They don't create an education arm of their brokerage firm. They don't do that. They want you to place your money under management with them, and then they ran it for you and charge you fees and make money off of you that way. They don't want you. They make more money that way than they do on the commissions if you're trading for yourself. Does that make sense? The fees that they charge to manage your account for you are higher than what you pay in commissions if you're trading on your own. So, as much as I dislike it, you can see it from a pure business standpoint, right? They make more money that way, and that's the way they do it. Who does it hurt? The individual person that wants to trade on their own and not pay those fees to have somebody manage it for them. They want to learn and control their own money instead of having somebody else control it for them. So, anyway, into that soapbox. That one's too far gone. Let's move on. So, CMRE, um, cost Mare, I believe is how that Costamare. I believe that's uh, Spanish or Latin company. I believe Costamare is how it's pronounced. This one is a little more interesting. Yeah, it's having an update today, but notice that the separation here is not as high as it was with Walmart or with the IYT. And we certainly want to see, wow, look how strong that ADX is. Holy cow. That was a really strong move from the end of October up till now. And look, the directional indicator is going back up, continued movement there. This one I'm going to have a little bit more doubt on as far as liquidity, but boy, that one's really interesting. Even if it were to pull back a little bit, look, the CCI came back to the 100 line and is moving up as well. This is getting towards as close to an ideal setup as you can get. Look where the money flow has been strong into that as well. So let's see what the options look like here. It's looking so promising that my guess is, yep, that's what's going to happen. It's so frustrating when you see something like that and you're like, wow, that looks good. That looks good. Ooh, this one looks like a really good candidate. And then you go look at the open interest and it's dismal. It does have January options, which do have some liquidity in it. It is helpful. I mentioned this before. Your first sign when you look at an option chain, when you click on that options button on the software, the first thing I look for is, are there January options? If not, already a high percentage chance you're not going to have enough liquidity. So we do have January options, we do have some liquidity, and yet here are those wide spreads again. Man, you almost have to go in the money on this one, and it even violates our $500 rule, even for the Jan options. Um, but that's where you have to go to get a spread that's at least reasonable. But then you go that far, and the open interest dries up. Man, that has been such a change in the years. I like to think we've had some sort of a um, influence on that. When I first started trading, there was no open interest on out of the money options. People didn't trade there. They traded at the money and in the money. And there just wasn't the open interest. Nobody understood the delta curve. They didn't understand gamma, and all these things that we've been able to educate people on over the years. And now they're figuring out, oh yeah, I can get better acceleration. If I go out of the money around 30 delta, 25 or 30 delta, than if I go in the money. And then if I'm wrong, you fall down that delta curve and you lose money rather quickly. In the money options, I think, are a viable alternative when you have a low dollar stock and you don't have a big move ahead of you. I think I've talked about this within the last week or two, but it bears highlighting again. It's a $16 stock. The target is basically $1 away. How much acceleration are you going to get on a $1 move? Probably not a lot, which means that that delta gamma acceleration that we talk about is muted a bit in a scenario like that, because it just doesn't move enough to gain that acceleration advantage. So when you see that, that's the one time when I'm like, okay, this is the time that it's okay to go in the money. Um, but you need to have a setup like this. You need to have a very solid setup, because when you go in the money, you lose money faster if you're wrong or if it pulls back. So all those things, everything is risk reward. It's all risk reward in the world of the markets, no matter what aspect of the markets you're talking about. So when we look down here, um, only 26 contracts at a 75 delta. That's really where the top of the delta curve is. There's no acceleration of delta from that point. It's just going to be basically you earn the delta, but it's not going to move very quickly. Uh, and then you're going to have to, $1.20 is still a little bit high. It would be okay if it was, um, it's $1 difference between there, between the uh, spread here. And the midpoint would be, so it was $1.50, 5.90. So 59-cent spread, 60-cent spread would be okay, but it's $1 wide. So it's a little bit too wide, but that's the only way you're going to be able to get in this. And then with the Jan options, it needs to continue higher. Um, Going in the money, you have less tolerance for the backing and filling and the time that it takes to get in, because any sort of pullback, you feel immediately in the red. Just for the heck of it, let's see if there's anything out in March. A little better than I thought it would be. There is some liquidity there going out to March. Um, we go back in the money here. Um, hmm, that's that's interesting. Um, the March in the money options, still the spread's too wide, but um, we'd have to look at that. So uh, if the delta, if you wonder why is that delta not there, um, it's because they haven't. It hasn't traded today, so they didn't put the delta on there. I'm just, sorry, I'm thinking while I'm trying to talk, which is not a good thing. In my case, hard to do more than one thing at a time. Um, but when you look at $1.40 spread, and if we, yeah, see, that's just, it takes all the gain away. Um, you basically could get in at that March 13. I imagine that delta is around that 75, might be a touch higher because it's a little further out in time. So even when we make 80 cents, on this $1 move. So the calls make 80 cents, but we've got $1.40 here. If we split the spread, getting in and getting out, so 70 cents in, 70 cents out, it's $1.40. We could actually have this move up and hit our target and still not make any money on it. So, yeah, that's when it becomes quite frustrating. And that's where, uh, I used to hear this all the time traveling around doing seminars is the fact that this is rigged because I bought calls, I was right, and stock moved up and I didn't make any money. Well, how much analysis did you do? Did you go through all these variables, or did you not go through all the variables and the answer was already there that, hey, you can get into this and it can go up and you're not going to make any money off of it? So, I go back to this is the last analogy that I'm going to go through, and I've spent so much time going through the education stuff. Zach, we'll open it up to Q&A here in a moment. But I remember I had the same kind of phone. I'm a creature of habit for a very long time. And then I decided to switch brands of the phone. And when I got the new phone, I hated it. I couldn't figure out how to use it. And so I brought it back to I don't want to tout any one of the providers, but I brought it back to him. I was like, man, I don't like this phone at all. What can we do? And he looked at me and made such a profound statement. And he goes, do you not like the phone or do you not know how to use the phone? And I just said, fair point. I just wanted to be able to pick up the phone and start using it. I didn't want to take the time. This is a different brand. I got to figure out where everything is on this brand. How's this brand work? How is it different than the other one that I had? All that stuff is common sense, but we just have such short attention spans. We don't want to do that. And so I said, you're right. Took the phone back with me, then did, the analysis and found out I really love the phone. But I hated it in the beginning. So that's what happens in the world of trading. And I don't like hearing when things are rigged. Yes, the market makers can tilt things that frustrate us at times. Um, but I don't view it as being rigged. They're trying to make a little extra money, just like the investment firms are. Everybody's trying to make money in the world of trading. So, um, it angers me, it frustrates me, but it's understandable as well. So, with that, I'll stop talking. Zach, let's get to some questions. We got the top three there. While you're bringing up a question, I'll just run through the rest of the list. As expected, not really much on the Wave 5 bullish side. There was one. I'm going to back up again. I want to show this one, Zach, before we get to the Q&A on the Wave 5 bullish search. SMG here, I think is pretty interesting as well. That was from last week's list. Been watching it, and you can see we're still in the blue box. So it's still interesting. But I wanted to see a clean break of that 50-day moving average. Even when we broke it with follow through back here in November, it still came back down to support at 52.5, but it hit the midpoint of the tap box. It went to exactly 100% extension. So when you look at that and you see a wave four, call it 50%, somewhere in the 50 to 61.8% range, which is going to give you 100% extension in a zigzag, which it also did in the wave five. That's a logical point. We came down here end of October. We tested it towards the end of November. That looks pretty solid as far as support there. And maybe we're ready to move back up, even if we don't go back up to the previous wave four, which we're right on the border. What do you do when you're just barely over 100%? Does that go back to the wave four or only a fib level? I can tell you I'm going to get out before it, waiting for a move all the way back to the wave four, but still some prudency of we're below the 50-day moving average. Let's let it show a changing of the guard. That's what a wave five trade is that the wave five is ended and you're going through the retracement. So let it give you the proof, the Missouri thing. So we closed right on it here. We did break above it, so we were looking for follow through yesterday and didn't get it. And so we're kind of status quo today. Let's keep an eye on this one. That's what I'm doing. If you're wondering, why didn't that alert get sent out? That's why. I want to see it break. Look how much room there is for that to run. There's plenty of room. Let's let it break above the 50-day moving average. Give us a follow through day. Still no guarantee, as you can see here, but let's try it. It wanted to come down and test support one more time. But if we see that, then that alert will go out. But for now, if you're wondering why didn't he send that one out, that's why. All right, now Q&A, Zach, I promise.
No worries at all. There's actually no outstanding questions at the moment.
Oh, wow. Did I just dazzle everyone today? Or did I bore everybody to death with all my soapbox speeches? All right, well, if there's no more, then let me take one quick look here at the sideways list, and then we'll send everybody out to the rest of their Wednesdays. And nothing, they're all low scores. And that's kind of been the status here lately on, there's not going to be a list there on the time strategy components. Scores are a little bit lower. It all rotates around. That's why we do level 3. When one listing is hot, the other one's cold, and vice versa. And that happens, the rotation all the time. So you can see going back over the past week, there just haven't been any time strategy signals that have been high enough scores to do anything with. And then the scores aren't quite low enough to do the fade trades. So they've all been kind of in between. All right. So thanks for your attention, spending some time with us this afternoon. And hopefully we'll be chatting with all of you tomorrow night during the Insiders meeting. Have a great afternoon. Look forward to talking again soon. Take care, everybody.